Imagine having the same tools to make millions as one of the greatest investors of all time, Warren Buffett. What if I told you there's a formula behind Buffett's massive success in the stock market, and you can use it too? In this video, I'm breaking down 7 powerful principles that Warren Buffett himself uses to make money on the stock market. These are not just theories or textbook advice. They're proven strategies that have helped Buffett build his multi-billion-dollar empire. Subscribe for more videos. But that's not all. Stick around until the end, because I'm also revealing the 20 most profitable companies in Buffett's portfolio. These are the companies he's trusted with billions, and I'll show you exactly how they're helping him earn returns year after year. If you're ready to learn the art of picking stocks, identifying winning companies, and using Buffett's own approach to grow your wealth, this is the video for you. Get ready to take notes, because by the end, you'll know exactly how to copy his strategy and start building your own portfolio like the pros.
When you buy a stock, you're buying a part of a business, not a lottery ticket. This is one of Warren Buffett's foundational views, and it highlights the importance of seeing investments as ownership stakes in real companies. Many new investors make the mistake of focusing on quick profits or daily price swings, but successful investing requires a mindset shift, thinking like a business owner rather than a speculator. Imagine you're buying into a local business. You wouldn't base your decision on the mood of other buyers or a rumor about a competitor. Instead, you'd examine the company's financial health, its position within the industry, and its potential to grow. In the same way, when investing in the stock market, each stock should be evaluated on the company's long-term viability and competitive edge. This perspective helps ground you in the fundamentals, so you're less swayed by short-term market fluctuations. When you adopt this owner's mentality, you stop worrying about the market's daily roller coaster. You begin to look at companies like Coca-Cola, Apple, or Johnson & Johnson as partners in your financial growth journey. This shift in mindset can lead to more rational, grounded decisions. Buying a stock isn't a quick trade, it's a commitment. Buffett's approach emphasizes patience, research, and the belief that solid businesses will yield returns over time. By focusing on the intrinsic value of each investment, you're building a portfolio that's not just a collection of stocks, but a carefully curated list of businesses you believe in. The goal isn't to ride a market wave, but to invest in companies with the strength and resilience to grow with you. Stay within your circle of competence is a core principle Warren Buffett has long advocated for. He believes that one of the biggest mistakes investors make is venturing into industries or companies they don't fully understand. When you invest within your circle of competence in businesses or sectors you know well, you're more likely to make informed decisions, anticipate challenges, and spot opportunities. Essentially, you're stacking the odds in your favor. Don't forget to subscribe now for more videos. Think of it this way. If you're deeply knowledgeable about the tech industry, you'll be far better equipped to evaluate tech companies. You'll understand industry trends, emerging technologies, and even competitive pressures that might not be apparent to others. This advantage helps you distinguish a truly promising investment from a risky one cloaked in hype. Conversely, investing outside your expertise, like in biotech or complex financial derivatives if you're unfamiliar, can leave you vulnerable to making poor decisions. Without the necessary insights, you could overlook critical information that affects a company's success or failure. Buffett's strategy is to keep his investments simple. He chooses companies with clear, understandable business models, which allows him to assess their long-term value more accurately. He famously avoided tech stocks for years until he felt he could properly understand them, even though they seemed highly lucrative. For him, missing out on certain hot investments is far better than risking capital on something uncertain. The key takeaway: resist the urge to invest in areas you don't grasp fully, no matter how attractive they might appear. Instead, focus on expanding your circle of competence over time, studying industries or sectors of interest until they're well within your knowledge base. When you stick to what you know, you minimize the risk of costly mistakes, build confidence in your decisions, and position yourself to take advantage of the right opportunities as they arise. Find companies with a moat is a cornerstone of Warren Buffett's investment philosophy. When he talks about a moat, he's referring to a company's sustainable competitive advantage, those unique qualities that help it fend off competitors and maintain profitability over the long term. Just as a moat protects a castle from invaders, a strong competitive advantage shields a business from competitive threats and industry disruptions. This strategy isn't just about picking companies that are doing well now. It's about finding companies that are built to last. There are several types of moats that can make a company resilient and rewarding to invest in. One of the most powerful is brand strength. Companies like Coca-Cola or Apple have global recognition and a customer loyalty that's hard to replicate. People trust these brands and often choose them over cheaper or newer alternatives, creating a consistent demand and pricing power that competitors struggle to match. Another valuable moat is proprietary technology or intellectual property. Take companies like Google, which dominates the search engine market, or pharmaceutical firms with exclusive patents on high-demand drugs. These types of businesses hold advantages that keep others from easily replicating their offerings. The technology or patents create barriers to entry for potential competitors, securing a dominant market position. A loyal customer base is another powerful moat. Businesses that have strong customer relationships, like Amazon or Costco, can retain and continually grow their market share. These companies often benefit from economies of scale, meaning they can provide more value at a lower cost, which attracts even more customers. Once customers are invested in a brand or ecosystem, they're less likely to switch to a competitor, which reinforces the company's competitive edge. Network effects also serve as a moat. Social media platforms like Facebook or marketplaces like eBay grow stronger as more people use them. Each additional user adds value to all other users. This self-reinforcing loop makes it extremely difficult for competitors to lure customers away, as users find increasing value in a network that's already established. Buffett's approach to identifying moats comes down to this: can the company withstand competitive pressures and grow over time? He chooses companies with moats because they're more likely to sustain earnings even in challenging economic climates. A strong moat means stability and predictability, which translates to reliable returns for investors. By prioritizing businesses with a competitive edge, investors can build portfolios that are not only more resistant to volatility but also poised for steady growth. Look for great management is another essential principle in Warren Buffett's investment playbook. While a strong business model is critical, Buffett places immense value on the quality of a company's leadership. Great leaders make great companies. Their vision, decisions, and integrity directly impact the long-term success and resilience of the business. For investors, understanding the people at the helm is crucial. One of the key things to examine is management's track record. Are the CEO and executive team experienced, with a history of successfully steering the company or similar businesses through both good and challenging times? Past performance, while not a perfect predictor of future results, can often indicate how management might handle upcoming opportunities or crises. Leaders with a strong track record are more likely to navigate difficult economic environments effectively, keep the company profitable, and consistently deliver shareholder value. Transparency is another essential trait. Buffett admires leaders who are honest, open about challenges, and realistic in setting expectations. A trustworthy management team will not try to sugarcoat the company's performance or hide setbacks. Instead, they'll communicate openly with shareholders, clearly explaining business strategies, market conditions, and potential risks. This transparency allows investors to make well-informed decisions and trust in the leadership's vision for the company. Alignment with shareholder interests is also critical. Buffett appreciates leaders who think and act like owners, treating the business as if they themselves were shareholders. Executives who hold significant stock in the company, for example, often have a vested interest in its success, as their own fortunes are tied to the stock's performance. This alignment encourages decisions that prioritize long-term growth and sustainable profitability over short-term gains, ensuring that shareholders' interests are front and center. Additionally, capital allocation skills are a distinguishing feature of effective leaders. Buffett watches how management reinvests profits, whether into research, acquisitions, or dividends. Great leaders use the company's capital wisely, channeling it into areas that will drive the most value for shareholders. They are disciplined in avoiding unproductive spending, focusing instead on growth opportunities that contribute to the business's strength and longevity. For investors, finding a company with great management can be a game changer. A skilled and ethical leadership team is often the difference between a business that thrives and one that flounders. By assessing a company's management based on their track record, transparency, and alignment with shareholder interests, investors can build a portfolio with greater stability, resilience, and the potential for long-term growth.
Be patient and ignore the noise is a fundamental principle in Warren Buffett's approach to investing. In the fast-paced world of the stock market, where prices fluctuate constantly, it's easy for investors to become anxious or tempted to react impulsively. However, Buffett stresses the importance of patience and focusing on a company's long-term value rather than getting caught up in short-term market noise. The stock market is inherently volatile. Daily news, economic data releases, and political events can lead to sharp price movements that often have little to do with the company's actual business fundamentals. For example, a strong, stable company might see its stock price drop due to a general market sell-off, even though its operations and prospects remain unchanged. Buffett warns against reacting to these temporary dips, as they do not reflect the company's intrinsic worth. Instead, he advises investors to concentrate on the long-term potential of a business and avoid making knee-jerk decisions based on market swings. This patience ties into the idea that time in the market beats timing the market. Attempting to predict market movements or time the perfect moment to buy or sell is notoriously difficult even for seasoned investors. By holding investments over many years, investors benefit from the compounding growth that comes with long-term ownership of quality businesses. Historically, strong companies grow in value over time, and their stock prices eventually follow suit. Selling prematurely in response to short-term price drops or market pessimism can result in missed opportunities for significant gains. One of Buffett's famous sayings, "Our favorite holding period is forever," captures this philosophy. He invests in companies that he believes will thrive over decades, not just months or years. This long-term approach allows him to look past temporary setbacks or market corrections and instead focus on the sustainable growth of his investments. Moreover, by tuning out the noise, investors can approach the market with greater peace of mind and avoid the stress that often comes with daily price monitoring. This mental discipline is key to successful investing, as it helps reduce the risk of emotional decisions that could lead to losses. Buffett's approach to ignoring market noise encourages a mindset of steady, informed investment decisions that prioritize the business's enduring value over short-lived market trends. In summary, embracing patience and focusing on a company's long-term value can provide a smoother, more rewarding investment experience. By resisting the urge to react to short-term volatility, investors position themselves for greater financial growth and stability over the long run.
Invest for the long haul is a central tenet of Warren Buffett's investing philosophy. Buffett is a staunch advocate of buying quality companies and holding on to them for long periods, letting time and compounding work their magic. For him, investing isn't about quick gains or constant trading. It's about patience, discipline, and a deep commitment to the businesses you choose to invest in. The wealth-building potential of long-term investing stems largely from compounding. When you hold a stock over time, not only does the value of the business ideally grow, but any reinvested earnings like dividends also generate returns on their own, leading to exponential growth. Buffett often says, the stock market is designed to transfer money from the active to the patient. By allowing investments to grow over years, or even decades, you enable compounding to work at its fullest potential, creating wealth far beyond what short-term trading can achieve. Avoiding frequent trading also has practical benefits. It minimizes transaction fees and taxes. Every time you buy or sell a stock, you incur trading fees, and these costs can add up over time, eating into your overall returns. Short-term trades are also typically subject to higher tax rates compared to long-term capital gains, which are taxed more favorably if you hold on to an investment for over a year. Buffett recognizes that by holding quality companies for the long haul, investors retain more of their returns and pay fewer taxes, enhancing their overall profitability. Buffett's long-term approach is also about mitigating risk. When you choose companies with solid fundamentals and a strong competitive advantage, time becomes your ally. Even if the stock market experiences short-term volatility, high-quality companies often recover and continue growing. Patience allows you to look beyond temporary setbacks and focus on the intrinsic value of the business. For example, during economic downturns, many investors panic and sell, locking in losses. In contrast, Buffett advises holding steady, knowing that markets tend to rise over the long run and that well-chosen companies can weather the storm. Another benefit of long-term investing is the peace of mind it offers. Instead of stressing over daily stock price fluctuations, long-term investors focus on business fundamentals, making investing less about timing the market and more about finding enduring value. This calm, disciplined approach keeps investors from making hasty, emotional decisions that often lead to regret. In summary, investing for the long haul allows you to harness the power of compounding, reduce costs and taxes, and avoid emotional pitfalls. By committing to quality companies and focusing on their long-term growth, you can build wealth gradually and more sustainably, just as Warren Buffett has done throughout his career. Embrace market corrections is a guiding principle that Warren Buffett has followed throughout his career. While market downturns often trigger panic among investors, Buffett sees them as valuable opportunities. In his view, a market pullback allows investors to acquire shares of quality companies at lower prices, setting the stage for significant long-term gains. For those who can keep a cool head, market corrections present an excellent chance to build wealth. Buffett's famous advice, "Be fearful when others are greedy and greedy when others are fearful," encapsulates this approach. During bull markets, prices often rise beyond a company's true worth due to high investor optimism. Conversely, in a downturn, fear and uncertainty can drive prices down even for well-established companies. By stepping in when others are selling out of fear, savvy investors can capitalize on these mispricings and acquire strong businesses at a discount. A key to this strategy is having a clear understanding of a company's intrinsic value. Buffett doesn't invest in just any company that looks cheap during a market correction. Instead, he focuses on businesses with solid fundamentals, a strong competitive position, and a reliable track record of profitability. He studies their balance sheets, cash flows, and industry positions to determine whether they'll be able to recover and thrive post-downturn. This disciplined approach ensures he's buying companies with the resilience to weather the storm and come out stronger. Patience and discipline are crucial during these periods. The temptation to sell and cut losses is strong, especially when headlines are overwhelmingly negative. But Buffett encourages investors to stay focused on long-term goals, understanding that downturns are part of the market cycle. Historically, markets have always rebounded after corrections, and companies with strong fundamentals tend to regain or exceed their previous value as economic conditions improve. Another benefit of embracing corrections is the chance to boost returns through compounding. By buying shares at lower prices, investors can lock in higher future returns when those stocks eventually rise. This strategy turns temporary losses on paper into gains over time, as the power of compounding amplifies each rebound. In essence, Buffett views market corrections as rare moments to buy into quality companies at favorable prices, not as times to exit the market. While it takes courage and discipline to follow this path, the rewards can be substantial for those willing to weather the temporary discomfort. By focusing on the long-term value of a company and viewing downturns as buying opportunities, investors can turn market corrections into a strategic advantage.
As of recent reports, Warren Buffett's Berkshire Hathaway portfolio consists of a mix of blue-chip companies known for their profitability and dividend yields. The following are 20 of the most profitable companies in Buffett's portfolio. 1. Apple AAPL. Dividend income. $820 million per year. Apple is Buffett's largest holding, valued for its brand, ecosystem, and consistent dividend payouts. 2. Bank of America backed dividend income. $910 million per year, a cornerstone of Buffett's financial sector investments. Bank of America provides high dividend income due to its large shareholding. 3. Coca-Cola Co. Dividend income. $700 million per year. Coca-Cola is one of Buffett's oldest investments, chosen for its global brand and dividend reliability. 4. American Express AXP. Dividend income. $340 million per year, a long-term holding. Amex benefits from Buffett's confidence in consumer spending and brand loyalty. 5. Chevron CVX. Dividend income. $800 million per year. Buffett added Chevron for exposure to the energy sector and its stable, high dividends. 6. Occidental Petroleum OXY. Dividend income. $200 million per year. Another energy sector pick. Occidental's dividends offer steady income potential. 7. Kraft Heinz KHC. Dividend income. $520 million per year. Is a major shareholder. Buffett benefits from its high dividend yield. 8. Moody's Corporation MCO. Dividend income. $100 million per year. Moody's steady growth in financial services provides smaller, but consistent dividends. 9. Verizon VZ. Dividend income. $300 million per year. Telecommunications is a stable income stream, with Verizon offering robust dividends. 10. U.S. Bancorp USB. Dividend income. $250 million per year. Buffett values this for its steady returns and dividends. 11. BYD Company. BYDDF. Dividend income. $50 million per year, though dividends are modest. BYD's growth potential in electric vehicles interests Buffett. 12. Charter Communications CHTR. Dividend income. $100 million per year. Charter's dividends are small, but its value lies in cable and broadband services. 13. DaVita Inc. DVA. Dividend income. Non-dividend. While DaVita does not pay dividends, it's valued for its business and healthcare services. 14. The Bank of New York Mellon BK. Dividend income. $100 million per year. Buffett benefits from BK's consistent financial performance and steady dividends.
15. Liberty Seriosum Group LSXMA. Dividend income. $40 million per year. As IRIUSXM is favored for its media reach, though dividends are modest. 16. Johnson & Johnson J&J. Dividend income. $80 million per year. Although Buffett's stake has fluctuated, J&J provides stable dividend income. 17. Snowflake Snow. Dividend income. Non-dividend. Snowflake's growth in cloud data services is a key reason for its presence, not dividends. 18. Visa. Dividend income. $50 million per year. Visa offers small but reliable dividends alongside growth in digital payments. 19. MasterCard MA. Dividend income. $40 million per year. Similar to Visa, it's valued for digital transactions and modest dividends. 20. Procter & Gamble PG. Dividend income. $50 million per year. While Berkshire's stake is smaller, PG's dividends come from its consumer staples dominance. These estimates give an idea of how dividends alone contribute to Berkshire Hathaway's annual revenue from Buffett's core holdings. The real profitability, however, often lies in the appreciation of these stocks over time, reflecting Buffett's strategy of choosing companies with strong fundamentals and the potential for long-term value growth. By following Warren Buffett's principles and understanding his top investments, you now have the foundation to make smarter choices in the stock market. Remember, patience, discipline, and knowing the true value of a company are key to long-term success. If you found this breakdown helpful, Make sure to subscribe for more insights on wealth-building strategies. Join us on this journey and let's keep growing together in the world of investing.